Hey guys, what's going on? So, the question is AMC really just a bank liquidity play? How much does this really depend upon banks to get in trouble to go ahead and allow for this squeeze to happen in AMC? Well, there's a few things. But first, full disclosure, I do currently own AMC. I did own it during the run up. In fact, I even had a $88 option that I purchased that went up in value to $4,000 when the day of the surge. I ended up, excuse me, selling out of it for $2,000 on that option because, as you know, after that day, the price started to fall. But I ended up making, pretty nice chunk of change for my $88 investment on an option and able to cash out at $2,000. But we're going to look at this. So why AMC stock has been on the threshold list. So that's one of the things that we're going to cover. So we're going to cover why it's on the threshold list. We're going to look at counterparty risk. We're going to look at some things in terms of how the interest rates are going to affect where we are in terms of the time scale for the AMC to actually have its squeeze and why it may actually happen. So, according to AMC Entertainment CEO Adam Aron, AMC stock has been on the New York Stock Exchange threshold securities for over 3 weeks now. We know that it's been over for 3 weeks because we can click on that. We can go to the most recent week and you see AMC right there. And then we're going to go back all the way until 13th. And of course, you see it right there again. Okay, so it's been on here for a while and it'll probably remain on there, obviously, for a while until they go ahead and clear these FTDs. So we know, though, that's an issue, right? We know that these failure to delivers are going to stack up and they're going to add up. Now, the key is to understand, though, the counterparty risk. So when we look at counterparty risk, we want to understand, okay, what is the counterparty risk? So this is a comptroller currency. It's a government entity that is appointed to basically look and govern over the banking industry. So counterparty risk is the probability that the other party in an investment, credit, or trading transaction may not fulfill its part of the deal and may default on contractual obligations, right? So we know that, again, the comptroller currency, what are they there for? Well, the Office of Comptroller Currency is an independent bureau within the United States Department of Treasury. It was established by the National Currency Act of 1863 and serves to charter, regulate, and supervise all national banks and thrift institutions and federally licensed branches and agencies of foreign banks in the United States. Okay, so banks like HSBC is a foreign bank, but it operates in the United States. Okay, so we have that element where we have to look at the banks because the banks are the ones that supply the liquidity to hedge funds to be able to short AMC. They don't just have all this money on their own. They're getting lines of credit. They're getting margins, right? When you operate in your brokerage account, they're connected to a bank, right? They're backstopped by a bank in order to offer those margin and those leverage products. So we're going to look at this article that you see here. We're going to look at this article now. This is an article from 2012. So you can see right here that that's from 2012, right? So this is right after the GFC, or the Great Financial Crisis, right? That happened in 2008, 2009. So we're going to look at this. Learning from failure, all right? Counterparty risk is a challenge faced by all players in the financial industry. Pre-2008, banks believed that hedge funds were one of the greatest sources of counterparty risk. However, in 2008, when Bear Stearns was rescued by JP Morgan and then Lehman Brothers Holdings Corp collapsed, it became clear that the risk could be reversed and banks have the potential to pose a major risk to hedge funds, right? So we know normally it's saying, oh, okay, well, this hedge fund, it's going to, we're dangerous because this hedge fund is going to blow up. And then the money that the banks lent to that hedge fund going to go under because, it's like the old saying, if I borrow 10,000 from the bank and I default on that, well, I'm in trouble. But if I borrow 100 million from the bank, well, they're probably in trouble, right? So continue on. When Lehman's folded in September 2008, many funds were frozen frozen with trades they couldn't close, and therefore resorted to invoking inside pocket and gate provisions in order to manage liquidity, right? So you had an issue with paper being able to move back and forth. Now, in the 4 years since then, managing counterparty risk has become a critical component of hedge fund operations. Now, why is that so important? Because it's telling you, just like you had the issue with Archegos. Archegos is a hedge fund, but that went under, and they actually endangered the banks. But now, in here in this article, they're talking about the banks endangering the hedge funds. So it's kind of like the tail wagging the dog now, so to speak, right? You have a different type of issue and a different risk. So we need to look at some of those things in terms of the risk with the banks. Now, let's look at the bank. No, we don't want to go right there. Oh, yeah. So we want to look at the risk with the banks in terms of the costs associated with it. So we know that when we're looking at something in terms of banking finance, obviously interest rates are a significant thing that we need to consider. So if you look at where we're at in those Fed funds rates, so oh man, this thing just messing me up on my stuff. So if we're looking at it, so here's Gergaven talking about Credit Suisse default swaps hit new all-time highs. Now, credit default swap is basically a bet that a company is going to go down. It's like an insurance bet. So if the company goes down, you get paid out, right? So Credit Suisse obviously has been in the news a lot lately, and talking about how their company, their banking operations are at risk because they are one of the banks that supply hedge funds with a lot of capital. So can you imagine, right? If credit default swaps are going up and hitting all-time high, that means there's risk of that bank failing. If that bank were to fail, that means that the credit lines, any of the monies that is lent to anyone else, that money is now not going to be available to lend out anymore. Okay, so if that happened, imagine you're a hedge fund and you are having an evolving credit line, and you're pulling from that credit line in order to run your company. You run your hedge fund, whether it's short or long. Your positions are in danger if they're leveraged because you're using that money. Because if that money is there, then that money is going to get called back. And if that money gets called back, well, that means you have to do what? That means you're going to have to close out your positions, because when they wind down the operations, all the outstanding revolving lines of credit, all those get cut. Those are not going to exist anymore. So hedge funds are going to have to worry about a few things, and they're going to have to watch out. So let's see, let's go to the next piece on here. Oh, real quick. So the CEO, oh, this thing is just messing up. Forgive me, folks. Some of this stuff, when you have it laid out, it doesn't necessarily stay laid out. All right, so the billionaire co-founder of Home Depot companies Home Depot compares the Fed to the gang that can't shoot straight. All right, so basically he's saying that they had raised interest rates too high, and that's what's causing a lot of these issues in the banks. He had caused these issues to go up, and because those interest rates are going up, guess what? Those hedge funds that borrow that money to go short, they're paying more. They're paying a lot more. So they're paying a lot more from two different perspectives, though. They're paying more because the person financing their ability to be in the short is charging more because the interest rates have gone up. Now, even if interest rates stall because of all the madness that happened last week with Silicon Valley Bank, and over the weekend with Signature Bank, we know that those Silicon Valley Bank, that was the second largest, biggest, and largest bank fail. But of course, they're being backstopped now, of course, by the government. They're saying that they're going to fulfill all of the deposits, and they're going to honor all those deposits, and people won't lose their money. But then you have Signature Bank, this is new news, and this is why I did the latest video, because they're now cutting short. They're cutting short the amount of liquidity that's going to be out there. Why? Because of that counterparty risk that we talked to earlier. Remember, banks also lend to other banks. So if they're having those issues, guess what? They're not going to want to lend that bank to another bank. They're definitely not going to want to lend that money to a hedge fund. Why? Because you start to change to a risk off environment, right? So there is a huge danger when you look at this stuff, right? Now, when we look at, see here, the Fed futures rate, I won't pull that up, but you can look that up on your own. But the Fed futures rate has gone down because of these bank issues that we've had. The Fed futures rate has actually gone down for the probability of the Fed doing a 50 basis point rate increase. Okay, because it was starting to actually was at one point I think it was over 50% chance of it doing a 50 basis point increase, but they lowered it and now it's down to like a 40 or 30% chance that they're going to the Fed futures are down to a 30 or 40% chance that they're going to increase the interest rates by 50 basis points. All right, so that's going to be a key thing to remember as well. Actually, I think maybe I didn't take a picture of that, but you can look that up. Now, that's the first aspect. Now, the other aspect, the cost. So AMC stock this is from the street. AMC is amongst the most expensive stocks to short. So to bet against AMC, short sellers must pay some of the highest fees in the market. The fees brokers charge to borrow stocks for short trades may vary. Trades vary depending mainly on factors of supply and demand. With borrow-free rates as high as 142%, AMC is one of the most expensive stocks to borrow right now. Now, this article was as of, I want to say maybe like, what is it? The 10th, so March 10th. But about a week and a half ago, the borrowing rate actually got up to 1,000%. 1,000%. That's how hard it was to borrow the stock, right? Now, analysts estimate that short sellers may have already lost as much as 430 million on their AMC positions this year alone. Okay, we haven't even made the first quarter and they're already 430 million. That's almost $500 million in the hole. Why? Because you have to pay to be in that position. And now that you have the interest rates going up, right, the bank liquidity is most likely going to start to turn down. Why? Because of that counterparty risk that we talked about earlier. Remember, banks lend to other banks, banks lend to hedge funds, banks lend to other financial institutions. But the key is liquidity here. If you don't have the liquidity, you can't keep the bet. It's not going to happen. Okay. Now, next thing we want to focus on is what is it right now? So this guy right here, Ortex guy on the AMC thread is pretty on point because he releases this information. Now, Ortex is something that you have to pay for. I think I want to say it's 50 or 60 bucks a month and maybe a little bit less if you pay for it annually. But looking at the daily, so that you see this is today, as you can see, this is 5 hours ago. Of course, today, what is it, the 13th? Today's the 13th. This is today, 5 hours ago. He does one in the morning. He does one in the afternoon after the market's closed. So the short score is 88%, right? But when we look at this, we can clearly see that there's an issue because look at, see right here, let me pull this up. So look at here, we have the estimated short interest fee percent is at 23%. Now, when you get something over, I think it's 21% is what Ortex says. When you get something over 21%, that's pretty big, right? Because you got to remember, this is information that is voluntarily given. It's not information that is this is given by the institutions that are shorting, right? They're not disclosing individual positions, but they're saying, hey, this is or excuse me, they are revealing individual positions, but when you go into Ortex, you don't know who's reporting what. So you don't know who's actually reporting those positions, but those are only the people that are willing to give that information to Ortex and reporting. What about the people that are not reporting? What if this is being short sold illegally? And there are naked shorts, illegal naked shorts, right? Because again, we talked about there are legal shorts and there are illegal shorts. So this does not account for those illegal shorts. Who knows what that percentage would be if we counted the illegal shorts? Now, you might say, well, dude, why are you pulling all this stuff from Reddit? Now, obviously, bear with me if you are currently, you know, if you're currently an ape and you're already in this play. All right. If you're new to this play though, but you haven't heard of it, then you might say, well, you're pulling all this stuff from a thread on Reddit, right? How valuable can that information be? Well, as you can see, there are 35, there's 500,000 people on here, right? 500,000 people. Now, why is this important? Because institutions are paying attention to this. Institutions are definitely paying attention to the fact that this is being used. Why? Look at this article right here. So this is Market Insider. Nearly 60% of institutional investors said they have used Reddit for investment decisions, survey shows. So a Brunswick group surveyed found 58% of institutional investors have used Reddit for investment decisions, and 46% of investors said they expected to increase their use of Reddit. Institutional investors look for ways to keep their pulse on the conversation among retail investors. Of course, as you know, because of COVID, a lot of people started investing. A lot of people started opening different accounts with a lot of these app brokers, for example, like Webull or Moomoo. And you see these guys advertise these a lot and signing up for these services, these broker services, a lot in their videos. A lot of times they're sponsored by it. There's nothing wrong with it. They're just a broker, right? And they're disclosing that they are sponsored by it. We're not currently sponsored by any of those. Who knows if we'll ever be. Not sure if we actually desire to be. But we're going to look at the fact that, okay, well, let's look at those. What are those people in that survey? What is it? What is the makeup of those people in that survey? So 2023 Digital Investor Survey, the age of information without limitation, about Brunswick. So what is the breakdown? Look at this breakdown. So this is the audience breakdown. We're going to look at these sections real quick. Majority active is the buy side, okay? Not the sell side, but the buy side, right? But those buy side, when you're a hedge fund, you buy and you short, okay? So we're going to look at portfolio managers make up 72% of those people. Buy side analysts make up 21% of those people, and 6% is just other, okay? So large, small investment firms, more than 500 million, 24%, 500 million to 2 billion, 18%, 2 billion to 10 billion, 27%, 10 billion to 100 billion, 23%, less than 100 billion, 9%. Okay. So obviously it's showing you there's large and small firms. Now, where are these firms located? Well, 47% of them, basically 50%, are in the United States. 10% of them in Canada, UK 18%, Germany 7%, and then other 18%. And the diverse range of experience, 41% are generalists, 59% are sector specialists. So, you know, energy, for example, is a sector. Housing is a sector. And then within that sector, you have different industries. So you might have home builders that are in the housing sector versus home builders versus the people that create the stuff to utilize and make those homes. For example, like energy sector may be an oil company. So you got people that actually go out and they distribute via pipelines, or you have people that are the explore. You have people within the industry that explore. So within each sector, you have different industries, which is just a subset group, and a group that's more focused on a portion of that sector. So, but my thoughts, just when you look at all this stuff, when you look at all this information, and you see interest rates being as high as they are, and you're seeing the issue that they're causing with people. You know, Grant Cardone, he even came out with a video just recently talking about, hey, you know, Powell, he wanted to break things. Well, now it's breaking, right? But those interest rates, right? They're just a form of handling inflation, because if we don't handle inflation, then guess what? If chicken comes to, $100 for a package of chicken breasts, you're going to have more people upset than that. And I know Chairman Powell got interviewed or grilled, I should say, at the Hill with not Janet Yellen. What's her name? Uh, I forget her name, but basically he got grilled, and the senator said, "Hey, well, aren't you worried about the 2 million people that'll lose their job?" And basically he said, "Well, yeah, but I'm worried about, the 100 million that have a job. I want them to be able to maintain a job and not just buy food and be able to pay their rent or their mortgage. I want them to be able to do something else." So you got a lot of issues that's coming up. Follow me. If you want more information on this kind of stuff. I'm not an AMC focused channel, but because I am in the play and I do know friends and family members that are in the play, I wanted to make this video so that they understand where, this squeeze could be coming a lot closer to a close than people think. Because again, I think it's based off of liquidity, and people's liquidity run out. Banks start to get in trouble. You have to remember that banks make up a significant portion of the S&P 500 in terms of the share. Of the weighting, of that index. So follow the channel, you guys. Shoot me a like if you found this information valuable. Give me a like. Give me a dislike if you didn't find it was valuable. It was a waste of your time. Make a comment. Holla at you. Bye.